You've been taking a look at some of the data. Put this into historical perspective for us, because there have already been like dozens of IPOs so far this year. How unusual is that for the second or third week of January?
So start out with 2020. That was a historic year. We had 316 IPOs on Nasdaq that raised $80 billion in capital. Last year, the first 2 weeks of January, we had 3 IPOs. This year, we've already had 48 IPOs, raising over $14 billion.
Wow. So why is the question?
Well, when you look at it, the capital markets are very richly valued right now. So the window is wide open. Of those 48 deals, 10 were operating companies, and they raised over $5.5 billion. And then 38 of those IPOs were SPACs, and they raised over $8 billion, $8.6 billion to be exact. So the SPAC attack is still on. We've got over 250 active SPACs out there looking for targets now. So I think one of the other big stories this year will be all of the business combinations that we're going to be coming to market as well.
All right, we're going to talk about that in a moment, but first I want to talk about the first day pops. Poshmark, for example, soaring 142%, which, nice to have the momentum, not good to leave money on the table. I spoke with the CEO, Manish Chandra, yesterday. Take a listen to what he had to say about it.
The fact that we are a public company makes me feel great. We're focused very much on the long term, and I think the short-term value creation is not where our focus is. We've been focused on our mission to serve the community, build out a great social marketplace, and just continue to grow and serve.
Okay, Poshmark hitting 150%. That was its high on the first day of trading. Affirm, 110%. Airbnb, 143%. DoorDash, 92%. You know, at a certain point, do we say the bankers are getting this wrong?
Well, I think Manish said it best. You've got to think about the long term. So first, for context, lots of these venture-backed IPOs are only floating about 10% of their shares. Then they're working with their underwriters to put those shares on the IPO into long-term holders' hands. So when we go to open up the IPO on day one with the opening cross, we can't find supply. You have all these buyers that are coming in, placing market orders saying, we want to own the stock. Meanwhile, you have everybody who bought the stock the night before trying to build up a larger position. So it's more of a supply and demand issue. But when you take it back again to the long-term focus, when a company sells stock through their IPO, they're setting certain expectations about their financial performance over the long term. So if the company was to go out and sell stock at the absolute highest price they could, they'd be signing up for much bigger expectations about the results they're going to deliver in the future. So I think it's always best practice, put the stock into long-term holders' hands, let the markets do what you do. And then really it's about the rest of the supply coming to the market once the lockup's off. And that's one of the reasons we continue to have conversations with companies about direct listings as a way to get more supply into the market sooner.
So I get the point about the long term, and we only have 2 days of data with Poshmark, for example, but you know, it's down 18% today. And you know, over the longer term, that doesn't look good when you talk about the momentum story, which matters. And so I wonder if it's putting these companies in a bad position that they can't seem to get the price right at the start.
Well, all the company can control is working with their underwriters to set the price of the IPO. They really don't control the first day pop or where it trades day two. So again, when you set that IPO price, we've seen a lot of deals pricing above the range. We've seen a lot of demand. And then on day one, when they go public, we've seen a ton of retail demand. And retail investors have really come into the market in a big way. Our chief economist, Phil McIntosh, actually just did a big blog post today about the impact of retail and the impact that has on the IPO market.
So let's talk about trends you're expecting this year. Obviously, SPACs are all the rage. Does that keep up?
Yeah, with already, as I mentioned before, over $8 billion raised in just the first 2 weeks, we've got a steady pipeline of new SPACs coming to market. And then we're in discussions with some great companies who are going to be coming to list on Nasdaq through business combinations. One of the unique aspects of a SPAC business combination that's different than an IPO is that the target company can provide projections about their business because it's really a merger, not an initial public offering. And so for lots of earlier stage companies that want to talk about their future growth potential, a SPAC business combination could be a great alternative to an IPO.
Now, startups are soon going to be allowed by the SEC to raise money on the New York Stock Exchange without paying big underwriting fees to Wall Street banks in what you call primary direct listings. And this is like a pretty big departure from traditional IPOs. And I wonder if you're at all concerned this might drive more companies to the New York Stock Exchange.
Well, so the SEC did approve a direct listing with a capital raise. New York's initial rule filing allowed for a limit order where the stock had to be priced within the range on the cover of the S1. We have a filing for a market order, which actually allows the company to price the stock anywhere from 20% below the bottom of the range, all the way up to wherever the stock wants to price on the day of the auction. We think a market-based order is a much better approach. We'll, of course, be doing a similar filing to New York in terms of having a limit order option for companies so that there's no regulatory arbitrage. But it's just one other example of innovation here at Nasdaq to help drive the capital markets forward.
Okay, so if we saw 48 IPOs in the first 2 weeks of January, what do the second 2 weeks of January look like? We've got an inauguration coming up, hopefully a peaceful transition of power, but it's been a rocky few days in the markets and in the world, and certainly Washington, D.C. Will that impact the next 2 weeks?
You know, IPOs are always affected by volatility. We're, of course, all watching the situation in Washington and state capitals around the world and hoping for a peaceful transition of power. But one of the things we will see coming up, we have some great names. We've got BUMBLE coming up. We've got Qualtrics on the enterprise software side. We've got OrthoClinical on the healthcare side. So lots of exciting names. And then, of course, all the exciting biopharma companies that just announced results at the JP Morgan Healthcare Conference will be hitting the road and looking to price their IPOs over the coming weeks. So a lot of activity coming up.